Welcome to this Killik Explains Finance video. This week, 7 things an investor shouldn't say. So I'm going to start by setting the scene with two wise men. These two guys we should pay attention to. Investing should be more like watching paint dry or watching grass grow, said a Nobel Prize-winning economist, Paul Samuelson. My other wise man on the right said the capricious and irrational behaviour of stocks makes investors behave irrationally themselves. And that was Warren Buffett, US billionaire investor. So we're going to keep an eye on those two thoughts and think about why it is we get so many things wrong as investors. And part of the reason is that we're only human. What I mean by that is investors should be all these things on the left. They should be logical, they should be rational, they should be consistent, they should basically be a bit boring. However, we are all human beings, so actually we're prone to be moody, emotional, quite unpredictable, and quite easily distracted. How do you get from the right to the left? Well, let's look at 7 things, my unmagnificent 7 things you shouldn't say to yourself or do. Now, here they come. It can't get any cheaper, and I'm guilty of all of these, by the way. That is a classic example, only one of what's called irrational thinking, to give it an official label. Basically, I've bought stocks and they've been at 8p, thinking it can't go any lower than 8p. Actually, they can go all the way down to 0, potentially wiping out 100% of your gain. That is me making the mistake of thinking a low price means the stock is cheap. Number 2, I took a 10% gain and moved on. Now, systems are great. By all means, have some sort of system by which you review your portfolio, adjust it, buy and sell stocks. But don't lock yourself into one. So a 10% gain is fine, but there are stocks in the past where I could have made loads more than that by just letting my winner run for a bit longer. This many people can't be wrong. This happens in and outside of investing, herding. It's the idea of irrational exuberance pushing the market up. All right, so actually lots of people can be wrong. They get carried away. So you follow them in and buy high, and then they all dump their stocks together, panic at the first media story that comes along, dump stocks, and you end up basically selling low. And those two things are the opposite of what you should be doing. It's called herding. This many people can be wrong sometimes. You need to stick to your guns, stick to your strategy. Once I get back to what I paid, I will sell. That's anchoring, and we all do it. We're all stubborn. We all say, well, I paid X amount for these shares, and until the share price recovers to that level, I'm going to cling on in there. It may never recover to that level. If circumstances have changed, you might be better off liquidating the shares, moving on. I had no choice but to dump my shares. Now that's poor planning. That is somebody saying, oh crikey, suddenly I was made redundant, I got ill, the roof started leaking, those things do happen, and I liquidated a chunk of my portfolio because I can, because shares are easy to sell. No, that's why we recommend having the rainy day fund set to one side, in cash, ready for those circumstances, so you do not have to start liquidating what should be a long-term investment. Those losses were pure bad luck. Now that's one way of cutting the overconfidence card. Basically as an investor, you've got to look back, assess both profits and losses. What was I expecting? Was my loss unexpected, and why did it happen? Was my profit unexpected? It's all too easy to say, well, I just made a magnificent investment. But actually look back, review, and learn from each investment decision. I will sit in cash until the market picks up. Now that's an example of what I call market timing, and people are really, really bad at it. We all want to get in when stocks are as cheap as possible, sell them just as they peak. Everyone wants to do that, and that's why very few people manage to do it in practice. In other words, if you're not careful, you can end up, as I mentioned, buying high and selling low, and you should be doing the exact opposite. So market timing, not a good idea. And I will sit in cash until the market picks up. That probably means you'll sit in cash until it's too late, and most of the next upward lift in share prices has already happened. So volatility in the short term makes us bad market timers over long periods. Lots of ground covered there, more to know, so any questions, editor@killik.com. And don't forget, our extensive library is at killik.com/learn.